Good afternoon. Thank you everyone for joining us today. I'm Valerie Arnold, Head of Intermediary Distribution at Pzena Investment Management. I am here with our Co-Chief Investment Officer, John Getz. John has been with Pzena Investment Management for over 20 years, and he is focused on our global and non-U.S. value strategies. Here at Pzena, we are solely focused on one thing, value investing. With a global research team of 24 professionals, we use fundamental research to build our portfolios from the bottom up, company by company. From the beginning, our objective was to build a premier global investment manager. Currently, we manage $32 billion in assets under management, roughly half in our U.S. small, mid, and large cap value strategies, and the other half in our global, international ex-U.S., and emerging market value strategies. What differentiates us from other investment managers is our relentless commitment to deep value investing under all market conditions. We have a unique team-oriented culture that allows us to stay invested in the cheapest part of the market throughout an investment cycle, which we believe provides the best long-term alpha for our clients. Throughout the call, please let us know if you have any questions by typing them into the question box so we can answer them at the end of John's presentation. And now let me turn it over to John for his outlook on the global opportunity for deep value investing. John.
Thanks, Valerie. Hey, at the outset, I just want to say thank you for taking the time to tune in today. As Valerie said, we spend our lives here at Pzena trying to find good businesses that are very undervalued. We have a very systematic approach to that. I think when you say you're deep value today, sometimes people think that means you're not necessarily focused on buying good businesses. Since our beginning 21 years ago, we've been repeating the fact that we are trying to find good businesses that just happen to be trading at ridiculously low prices. I want to talk about two subjects today. One is where are we in the value cycle, and I just want to point out at the outset here that we think we're early in probably what is a very attractive value cycle, multi-year value cycle. So let me just say that. Now I'll talk to you about some of the principles of that. The second point is this catchy title we have, Does It Pay to Pay Up? And really addressing why are there discounts today and what kind of discounts are there for undervalued businesses. So with that, let me first address the value cycle. One of the ways that we show the value cycle is by looking at spreads. In this slide that you have in front of you, we're just simply looking at the gap between the valuations for the cheapest quintile on a price-to-book basis and the fifth quintile or most expensive quintile of stocks on a simple metric price-to-book. And we use the simple metric simply because it's simple and you can look at this series over many, many years. One of the things that should jump out at you from these slides is that in all the major regions of the world, the U.S., Europe, and Japan, spreads got incredibly wide, as you see here measured in standard deviations, a 3 standard deviation spread in the U.S., 2 standard deviations in Europe, and also around 2 standard deviations of Japan by 2015. We called that out, actually, if those of you that know us, we called that out saying this is getting pretty ridiculous. Obviously, values had a rough run, and it was interesting that these spreads had gotten so wide. And then last year, as good fortune would have it, the value cycle did appear to turn, and you see that by the shrinking spreads on this, and obviously the very strong outperformance that we experienced in 2016 in most of our portfolios around the world. Now, interestingly enough, the first quarter of 2017 actually had a very slight, you can actually see it on this chart if you get your magnifying glass out, a little bit of widening of spreads, and that was consistent with the fact that actually the first quarter was not a value quarter per se. If you looked at value indices, they trailed slightly in most of the regions of the world. But one of the questions I get all over the world today is, where are we? Well, first of all, I'd say spreads are still wide. And then the question is why? Aren't we just stuck in businesses that aren't nearly as attractive as the businesses that might be selling for higher prices? And we wanted to address that, so we did some work this quarter on trying to illustrate to our clients exactly what you're paying for by buying in the fifth quintile versus buying in what we're doing in our first quintile. So let me talk about some of the issues there on this next slide. In the United States, what we've done here on this slide is we show the 5 quintiles according to our model. We have a screening tool that we use that simply compares the stock price to what the business should earn, and we have a proprietary model for that, and we call it the normal earnings power of the businesses. And we rank these stocks from the cheapest to most expensive in this model. What we did here is we said, why don't we look at all the companies in Q1 and see what they look like on average, and see, are we forced to buy something that's of inferior value vis-a-vis stocks that are more expensive. And one of the things that jumps out here is, first of all, if you take the Q1 companies, what you see is that in aggregate earnings, they actually have more earnings than the fifth quintile by a wide margin, as they do versus Q4 or even Q3. What I like to point out here is that probably stands to reason, because the stocks in Q5 are the loved stocks, and the stocks in Q1 are the stocks that aren't loved at the current time. But is there a good reason not to love them? So look at the next two columns: historic return on equity, historic revenue growth. This is where it kind of gets interesting, right? On historic return of equity basis, what you'd see is that the historic return on equity isn't that different. In fact, the lowest historic return on equity is in Q5 in our model. Likewise on growth, what you'll see is, yeah, there it makes sense. Q5, the most expensive stocks, has the highest growth rate of 13%. But if you go and look at the other four quintiles, they have comparable growth rates in the history. And then you go over to the valuation metrics: price to earnings, price to sales, and price to book value. That's where you begin to see some pretty dramatic differences in our model, paying a lot less for earnings, a lot less for sales, and certainly a lot less for the book value in Q1. Okay, that's the U.S. Let's go to the next slide we have, which is, markets outside the U.S. And interestingly enough, a very similar phenomenon. You're buying earnings cheaper in the first quintile, but you're not necessarily getting worse businesses. Certainly, if you measure quality by historic return on equity or growth, you'd actually see here that on average, the stocks in our first quintile actually have slightly higher growth than the average, and also slightly higher return on equity than the average outside the United States. Very interesting. Again, because we're screening for valuation here, and that's how we're ranking stocks, you'll see that the price to earnings, sales, and book value is very attractive, with Q1 being less than half the price of average on a book value basis, a little over half the valuation on an earnings basis. So very interesting that in actual fact, what we're pointing out here is that if you use our screening tool, you would find stocks that on average are decent quality, decent growth, but trading at a much lower price. Now, I think you all know what the punchline is. The punchline is there must be some controversy on every one of these stocks that's trading cheaply in Q1. So let's just dive into that a little bit. We have a few examples here on this chart. Let me start with what I call the loved stocks of the world today. Now let's just back up for a second and say, what does our world look like today? Hey, we're stuck in QE, quantitative easing. We don't know if the economies, developed economies particularly, are going to grow anymore. We certainly know that our discount rate is low because we're afraid of the future. So why don't I just go out and park my money in either a bond, which of course yields almost nothing today anywhere in the world, or maybe I could do better than that. Maybe I get a high-yielding, safe stock to buy. So what we picked on here is Procter & Gamble and L'Oreal. In both of these cases, you're paying up for them. You're paying 22 times earnings for Procter & Gamble and 26 times earnings for L'Oreal. Now the question is, why do you do that? Well, just cite a couple things. One, they have very steady earnings, so they seem to be steady, and you can trust them. You can trust the earnings power. They also have decently high returns on tangible capitals. You see 44% for P&G and 21% for L'Oreal. So you could describe them as good businesses. Now in the growth category, maybe not so much, not so good, right? I mean, Procter & Gamble doesn't seem to be growing very much. L'Oreal's growing at a slow rate. So I would say, hey, they're not really growth stocks. They're just safe, and we're paying up for safety. I'll just point out that they both have dividend yields around 1.7, 1.8%. So you could argue you're beating most bonds in the world by buying these stocks. So we're paying up for that in the market today. So what aren't we paying up for? Two examples from our portfolios, one from the U.S. side and one from emerging markets, and that's also in our international portfolio. So McKesson and China Mobile. Let me just start with McKesson. McKesson is the leading prescription drug distributor in the United States. It's an industry where 90% of drug distribution is handled by just 3 companies. So you certainly can describe it as good industry structure. They actually do provide value. Drugs are manufactured by a whole slew of companies all over the world, and they're distributed ultimately at pharmacies. In the United States alone, we have thousands and thousands of pharmacies. So how do drugs get from manufacturers to pharmacies? Well, they get there through these 3 distributors. On top of that, these distributors add a lot of value because they're actually the ones that go out and actually source generic drugs to replace prescription drugs that are formerly branded, by the big pharma companies. So they're actually providing a value proposition of going out and sourcing the generics to lower cost of prescription drugs for citizens of the United States. So I would say they have a good business, good industry structure, real value add. So why is the stock hated? Well, there's always a controversy. There are 3 big fears in McKesson today, which explains why their stock is about half of what it was a few years ago. One is we all read about in the newspaper, the government is crazy and they might be restricting costs in healthcare. Secondly, they did miss earnings. And thirdly, there was some pricing competition and a skirmish in pricing. So there's always a controversy when we get to look at these good businesses selling at low prices. Now, I can't spend a lot of time explaining why we have looked our way through these crises and figured out that we think McKesson is worth buying, which we're buying it today. But I will point out the fact that we're paying a very low price for what we think is a very good business. You see their historic return on tangible capital is actually 60%, which is really pretty tremendous. And they do have revenue growth because total drug spend continues to grow. So with that, I will also point out that they have a dividend yield that's above 3% today. So no matter what metric you use, I would say we're buying McKesson at a very attractive price when to buy a comparable business that is deemed to be safe with no controversies, you're paying about double. This is also true for China Mobile. China Mobile has almost 2/3 of the market for mobile telephony in China. They have 25% of the market cap in cash, so they have a great balance sheet. They're the 4G leader. They have invested in front of their competitors in the next wave. And yet we're buying this stock at 14 times current earnings, and it also has a good history of growth and return on tangible capital. In this case, around 38% is shown on the slide. Again, dividend yield here is above 3%. So why don't people want to buy China Mobile? Well, guess what? There's a few fears in China Mobile as well. They have a highly regulated price structure. The government actually sets the price for telephone rates, mobile telephone rates in China. So people are fearful of that, and the government keeps grinding it down. They keep reducing the price. Despite that, they actually have growing revenue per user. Why is that? Because while the rates for data and voice keep going down, the actual usage of data in China is spiraling upward. So they actually have more revenue per user today than they did a few years ago. By the way, China Mobile stock is the same price it was in 2008, just to let you know how attractive this might be today. Likewise, they get bad marks on corporate governance because of the fact that they typically pay out a relatively small portion of their earnings. Even though the dividend yield is decent, they pay out around 46% of their earnings today, and some shareholders would like them to pay out a higher percentage. But it's moving in the right direction. It used to be 42. So we look at this and we say, hey, China Mobile has a great business, good historic return on investment. It's actually growing despite price declines in cell phone rates. And we're sitting on a good business selling at a very low price. It just has to come with a controversy in order to be in the first quintile. So with that, I think I'll move on, but I just wanted to give you a flavor that we don't think we're buying inferior businesses at low prices. We're just buying businesses with controversies that need some research in order to see your way through. I will remind everyone that we are long-term investors. We don't need these controversies to be sorted out in a quarter. We want them to be sorted out in 2 to 3 years, and we look for that when we're going after companies. So those are 2 examples out there today. Now, I did mention at the outset that I think we're at an interesting point in the pro value cycle, even though there's a little bit of a setback in the first quarter. What we're showing here on this slide is all the cycles. This happens to be all the cycles in the United States going back to the 1970s. And in the table, what you'll see is the date of the cycle, what the returns were to value in the first 14 months, what the returns were to a naive value. By the way, this is just simply price to book, naive value, and then the length of the cycle. The most important thing we want to get you to here is that typically these cycles are long. They average 72 months, and this cycle started back in February 16, so we're 14 months in. Does it always go up in a straight line? Well, you can see from the lines showing on this graph for the various cycles that indeed there are many, many interruptions along the way in these value cycles. So we're in a pretty good place. We're finding some interesting businesses to buy in various parts of the world. I will tell you there are more controversies in Europe, as I'm sure you can appreciate. So we have a little deeper value in Europe and a little deeper value in emerging markets than we do in the United States. Actually, I point out I spend most of my time in other parts of the world looking at companies. That's my role here at Pzena Investment. But I will also tell you that the U.S. just feels safer, so obviously valuations in the U.S. are a little ahead of where they were in Europe and emerging markets. When people say, well, why do you think it isn't almost over already economically? I have one slide. I want to leave you with this, and I'll open up the questions. If you were telling me that the world was in a good place in 2015 or 16, and you were measuring that by what the heck is going on in the real world, not the world of QE or the world of the Wall Street Journal or the world of CNBC, but in the real world, what would it look like? And what we wanted to show is that, you know what, when China had to come off of a major spending boom that was initiated because of the financial crisis in 2008, I remind people that that started here in the United States. They put a lot of stimulus out there in the world, and in that physical world, they kept things going at a very attractive pace until around 2011, and they had to come off the accelerator. And the impact of coming off the accelerator in China has really been tough on a lot of real world businesses around the world. So what we're showing here is just the total capital equipment revenue going year-over-year growth numbers going back to 2011. What you see is 11 was a great year, 12 was a big slowdown, 13 was almost no growth whatsoever, 14 was negative, 15 was negative, 16 was negative. You get my drift there, right? It's been tough out there. And this, I think, is probably a slide that does relate to the global value cycle because a lot of businesses were facing tough headwinds for the last several years. What we're seeing in our meetings with companies now is a decent inflection, particularly outside the United States, a decent inflection in the outlooks for most of the major companies that we're talking to. Now, this is just an example of capital equipment companies, but it's not limited to that. It's most businesses that are impacted by the economic cycle are seeing a little bit of a turn to the favorable. So with that, I think I will take a big pause and open up for questions. I will just state once more that we think we're in a good spot in the value cycle and finding some attractive opportunities.
Thank you, John. At this point, if anyone has a question, please feel free to type it into the question box, and we will take your questions in a minute.
Okay, I got a few questions queued up, so let me take them. I'll just take them in kind of in the order that they're popping up to me here. One of them is, what are our expectations for the market overall, given that valuations seem to be at post-recession highs, both in terms of price and any valuation metric. One of the things that I remind people of is that one of the things when you measure, and Dr. Schiller up at Yale tries to do this, two pieces of that. One is earnings, one is price. One of the things you have to keep in mind here is if you were looking at the price of a bond today, you would say, wow, you're paying a very high multiple of earnings for a bond. In Japan, where interest rates are zero, you're paying an infinite price for earnings. So it doesn't surprise me that we're paying a lot for earnings around the world, because basically what's happening is our discount rate or our comparison rate has dropped a lot. I don't know how to address that. If we're stuck here, if money is still easy and quantitative easing is still here in 5 years, then there's no reason why valuations shouldn't be high. It's just the inverse of the bond yield, for those of you that are thinking about the math of it. I don't really have a strong view about the overall valuation of the market, but I will tell you that the things we're buying aren't inflated. And that's what excites me so much, is that we're able to find some things that aren't inflated. And I just gave you a couple of examples in my talk today. But I won't tell you that the U.S. particularly, which has the highest valuations in the world, couldn't have a pullback. Certainly it could have a pullback in valuation, even if it was just because QE was ending and interest rates were rocketing upward. So we don't really think of ourselves as experts on making the call of the next move in valuations. Another question, that I get is value only going to work if the economic outlook is robust? This is a question we often face. What we've witnessed over the decades now is that really businesses that have had a headwind, and I just gave an example of a tough headwind in capital equipment revenues because of the energy and commodity collapse, they're always facing headwinds. Actually, what you find in their earnings power is their earnings are first hit by what has happened in their environment, and really all they need is the headwinds to stop. They don't need GDP to start up like a rocket. They just need the headwinds to slow down and stop. This is true across the world today in some sectors that have had a really tough time. Financials is the king of it, right? QE has just been hammering spreads in financials now ever since the financial crisis. QE doesn't have to end. It just has to stop getting worse. And we're seeing the banks clawing their way back up in this earnings cycle right now, this quarter, clawing the earnings up by improvements in costs, et cetera, even without QE ending. So we don't need a robust economic environment for some of these cyclicals to work. We just need the environment to stop getting worse, and that's what's going on right now. Pretty exciting times in that respect. I just got another question. What's our outlook on emerging markets? We're pointing out, I don't have the slide here, but ranking valuations around the world. The real fear and the real controversies are in emerging markets and Europe. United States, is a little bit more out of the woods, so I think people are less fearful in the United States. I would say the outlook for the emerging markets from a valuation standpoint is pretty good. We have a lot of businesses that have come off of massive lows. Pacific Basin Shipping Company. I like to remind people that just 2 years ago, shipping rates were lower than they were in the Asia crisis in 1998. Okay, so they're coming off such massive lows that Pacific Basin has, a decent outlook of improvement, even though they've massively outperformed already over the last 12 months. So I would say emerging markets has many businesses that were wounded in this massive slowdown, and we see tremendous opportunity into the future. Emerging markets as a market is cheaper than it is in the United States. Same thing in Europe. Europe, we just had an election, fortunately. I think from a world point of view, the election came out the way we hope. I think Emmanuel Macron has a great chance at winning the next part of this election process in France. That would be good compared to an extreme right candidate taking over and going into protectionism. But nonetheless, I would say the fears of election problems in Europe are high. That has dampened valuations, and it's dampened companies' enthusiasm for the future and growth. So what I would tell you is this relaxation of fear could get growth nudging forward in Europe. We've been under a heavy wet blanket of fear for a number of years now, never mind that it started with the financial crisis. So I'm pretty excited about Europe and pretty excited about EM both.
Okay, well, thank you, John, and thank you, everyone, for joining the call today. John and I greatly appreciate your interest in our firm, and please see our contact information on the screen. For further information, you can find us at www.pzena.com. Thank you.